I do want to reinforce that we think after this short-term period of discomfort, and it is uncomfortable, believe me, I know, the rolling recession we've seen in the last few years will turn into a rolling recovery, and we're getting some green shoots already. Employment lags, so the unemployment rate probably will continue moving up even as this rolling recovery gets underway. And then we think next year we will be in much more of a productivity-driven, almost boom in economic activity.
There's a powerful shift happening right now in the global economy, one that most people are too afraid to see clearly. Everywhere you look, headlines scream recession risk, liquidity squeeze, and market crash ahead. But what if we're missing the bigger picture? What if this short-term pain is setting the stage for one of the most explosive recoveries in decades, not just for stocks, but for crypto? That's the argument ARK Invest CEO Cathie Wood is making in the latest episode of her monthly In the Know podcast. Known for spotting long-term innovation trends before the crowd, from Tesla to Bitcoin, Cathie believes the U.S. is transitioning from a rolling recession to what she calls a rolling recovery. She says that while things may feel uncomfortable right now, the economy is quietly laying the foundation for a productivity-driven boom, one that could completely rewrite investor expectations for 2026. Now, I know what you're probably thinking. Didn't we hear the same optimism last year? True, but Cathie's conviction isn't just blind hope. It's rooted in a detailed analysis of liquidity, interest rate cycles, and government policy changes already in motion. She argues that the current slowdown in both equities and crypto markets is temporary, caused by short-term liquidity constraints from the Fed and the Treasury, and that once these clear, the setup for growth will be undeniable. In this video, we'll break down exactly why Cathie Wood believes a rolling recovery is about to unfold, how it ties to the Fed's expected pivot, new pro-growth policies under the Trump administration, and why these developments could supercharge the next crypto bull market. So if you want to understand where markets are really heading and how to position yourself before the crowd catches on, make sure to hit that like button, subscribe, and let's dive right in.
I know the markets are extremely nervous right now. The equity market and the crypto markets especially. And we think we understand why, and we also think this too will pass. Because there are some very short-term reasons, mostly having to do with liquidity drying up, again, very short-term, associated with Treasury and Fed balance sheet, or the Treasury general account and the Fed balance sheet primarily. And so we'll go into that in a minute. But we think that they will clear up within the next month. We have, first of all, quantitative tightening ending on, I believe it's December 1st. Now, many observers expected the Fed to end quantitative tightening with its last meeting. It did not. That was a little unsettling to the markets. And we're hearing from various Fed officials that there is more fear that inflation will not continue to unwind. We have a very strong view to the contrary, but the burden of proof is on us. The indicators have been sticky. Tariffs are one of the reasons, even though business has absorbed, we think, at least half of the shock from tariffs. So quantitative tightening, we think, will end December 1st. That's a de facto easing. And then the various liquidity tightening moves have to do with the Fed reducing its reserves. We're now down to 6.6 trillion. And at the peak, I think we were close to 9 trillion. The Treasury general account is at 940 billion. Normal over the last 3 years has been 600 billion. So the Treasury because the government is shut down, is building cash and not releasing it into the system. The Fed has been very concerned about all of the easing and inflationary ramifications coming out of COVID, and they still are there, although they have been easing. Interest rates have been coming down since late last year, haltingly to be sure, but they are coming down. By some measures, and we'll go through the charts, while the Fed is easing, it is still quite restrictive. And so we need to hit that tipping point. And we do think that the next Fed meeting, which I believe is December 10th, will be the next decision, that the Fed will take interest rates down again. Now, I am a little concerned that we seem to have more hawks now building on the Fed. That's a bit of a change. We think that the labor market conditions are going to get worse, especially because at the end of September, I think the federal government let go 150,000 people, if I'm not mistaken. So they will get worse when they are reported. And I think that's going to change the dynamic considerably. So when will they be reported? Well, we need to get the government back to work. And the odds are, or the prediction markets suggest, that will be around November 17th. I did just see that Senator Thune is calling everyone back to work over the weekend on a continuing resolution. So it could be a little sooner than November 17th. But then the funds will be flowing again. So again, this is short term. I don't like what we're hearing from the Fed because I do think that they are missing some deflationary signals out there. And we'll get into a few of those. So let's go through the charts, and we'll start, as always, with the budget deficit, since that has been top of mind. A record-breaking deficit during COVID. It is coming back. You can see we're at 5.7%, which is better. We were not too long ago almost 8%, so getting better. And I do think there are a couple of things going on. The government shutdown has been accompanied by a reduction in force recently. So again, I think Doge is having an effect and an ongoing effect. And then on top of that, we have a more broad-based reduction in force. We know one of the pressure points, we've heard that Secretary Duffy has said that we're going to be canceling 10% of all flights. That's a little bit more pressure on the government to get this thing going. And then I'm going to show you a chart on SNAP. That's the Supplemental Nutritional Assistance Program. We'll get to that in a moment to give you a sense of really how out of control spending was, and in some senses still is. And yet this is a political football, as always. This used to be called food stamps, I think. Before going there, I do want to reinforce that we think after this short-term period of discomfort, and it is uncomfortable, believe me, I know, that the rolling recession we've seen in the last few years will turn into a rolling recovery, and we're getting some green shoots already. Employment lag, so the unemployment rate probably will continue moving up, even as this rolling recovery gets underway. And then we think next year, we will be in much more of a productivity-driven, almost boom in economic activity.
Cathie's optimism isn't blind. It's built on structural policy changes she says will directly drive a new wave of productivity, investment, and innovation. One of the biggest catalysts, according to her, is a provision buried inside the Trump administration's One Big Beautiful Bill, a sweeping tax package that allows for 100% depreciation in the first year on manufacturing structures, equipment, R&D, and software. To put that into perspective, companies that start new manufacturing projects before the end of 2028 will be able to deduct the entire cost in year one, massively improving cash flow and triggering a flood of corporate investment. This policy, Cathie notes, effectively lowers the corporate tax rate to around 10%, one of the lowest in the developed world. That's a game changer for global capital flows, because it makes the US one of the most attractive destinations for innovation-based investment. In other words, if you're building the future, America just became the cheapest place to do it. But it's not just corporate policy. Cathie highlights how these measures align with tightening social spending programs, an effort, she says, to curb excess government outlays and redirect capital toward productive growth. She points out that programs like SNAP, or food assistance, have remained elevated long after the crisis years, suggesting inefficiencies in the system. Cutting back on those while incentivizing real economic production, she argues, could unleash the next phase of sustainable growth, not inflationary, but productivity-led. And that's where her bullishness comes from. Even though unemployment may tick higher in the short run, Cathie believes that behind the scenes, the U.S. economy is rebooting, shifting from consumption-driven expansion to innovation-led output. Which brings her to the next key signal she's watching, one hidden in plain sight in the gold markets.
This is the ratio of the gold market cap to M2 and expressed in percentages. And what this is saying, given the rapid increase in the gold price during the past few years that we've seen, we wanted to assess, what does this metric look like relative to history? And what you can see here is two prior peaks near this level. One was in the Great Depression. And what happened is this peaked, I believe, in 32 or 33. And then it started moving down. We went through a reprieve in the Depression. Many people think it lasted throughout the 30s. It was at its worst in the early part of the 30s, or its most intense. And then in 1932, I think to 36, if I'm not mistaken, we had a reprieve and then a relapse in 37. During that reprieve, what we saw was money supply going back up. It had been declining, and the gold price was fixed back then. So all of this move was a function of money first declining. There was a deflationary bust, and the Fed wasn't picking up on it. And the Fed was fairly new. Or they wanted to make sure not to let inflation out of the bag. And so they tightened way too much. Money collapsed. GDP went negative. Pricing went negative. And you see here the gold price to money went up to its highest level ever. And then they started easing. And the stock market had one amazing move after that happened, with the smallest stocks, the lower cap of the spectrum, having absolutely spectacular moves. So that's the first time this hit its peak, and then when it started down, we had a huge burst in the stock market. The second time we hit a peak here was in the aftermath, or it was the rise was taking place throughout the 70s, early 70s, 71. We closed the gold window, and you can see what happened. There was a flight to safety, a hedging against inflation that took place throughout the 70s and peaked in 81. with inflation and interest rates, actually. And then after that, we had the golden era for actually both stocks and bonds. We went through a long period of disinflation, but especially the 80s and 90s were they were golden for the financial markets. Sure, we had our corrections here and there, but the financial markets did very well during that period. So here we are again, and I do think it's interesting and instructive. When did this bottom? It bottomed in the late 90s, early 2000s, when the Fed eased for three reasons. First was long-term capital in 98. Long-term capital threatened really a financial collapse. And the Fed came in for that reason. It came in 99 because of Y2K, the fear that the globe was going to shut down because the computers had been written for the 1900s and they left off 19. And we were entering a new millennium that would have to switch over to 20. And the Fed was fearful, and a lot of other people were fearful that the global economy would just shut down. So it eased for that reason. And then the tech and telecom bust. It eased for that reason. And I think as we're examining more about this period in history, that essentially led to an inflationary period that took oil prices in would have been 2008 to $147. We just broke below 60 on that basis. So it was a period of inflation. And then this latest period, I think, was set off by certainly the Russian invasion of Ukraine. And we saw a lot of sanctions and confiscation of Russian wealth. And I do think that's one reason the gold price got going. And then all of the other geopolitical risks out there, including still Russia and Ukraine, the Middle East, and China, especially under this administration, effectively declaring a sort of war there, economic war, technology war, if you will. And so there has been that flight. Now I want to go to the next chart, which takes apart the gold market cap from M2. Here you see it. And just to hearken back to the 70s, you can see, because they had been holding the gold price flat, the gold price, the gold market cap is the gold in the yellow there. And the purple is the money supply. So money supply was well ahead of gold back then. And, part of what happened in the 70s with gold, when we closed the gold window and allowed ownership of gold again, I think that was in 1974, we had, a massive move towards hedging against this inflation with gold. And it pretty much ended when the gold price or market cap crossed M2. And here again, that period, we had that quiescent period during the 80s and 90s for gold, but money supply was going ahead, but the velocity of money peaked in 97. And so it didn't, the money, that velocity rolling over, diffused the inflationary ramifications of a rise in the money supply. And you can see what happened, as we moved into the 2000s. After those three easing moves by the Fed, the gold price took off again and pretty much stopped when it hit M2. Well, here we are again. And in fact, we've gone beyond it, much like we did in 81. So I wouldn't be surprised if we are peaking gold relative to M2 now. And as I mentioned, these other two times when we peaked and resolved to the downside were really good times for the financial markets.
Cathie's analysis of gold's historical cycles offers a fascinating lens into where we might be in the macro story. As she explains, whenever the ratio of gold market cap to M2 money supply hits extreme levels, like in the early 1930s or the late 1970s, it tends to mark a turning point. Both of those periods were followed by massive rallies in equities and risk assets once liquidity began to flow again. And right now, that ratio is once again peaking, suggesting we could be on the verge of a similar reversal. Think about what that means. If history rhymes, as it often does, then this current environment, with tight liquidity, fear, and disinflationary pressure, could soon give way to a new era of monetary easing and risk-on behavior. The same setup that preceded the golden decades of the 1980s and 1990s could be repeating, but this time, with crypto at the center of the innovation cycle. Cathie's broader message is clear. Once the Fed formally pivots, likely in early 2026, and quantitative tightening officially ends, we'll see the full force of liquidity return to the system. Combine that with pro-growth tax incentives, corporate reinvestment, and technological innovation, particularly in AI, robotics, and digital assets, and you have the recipe for what she calls a productivity-driven boom. For crypto, that's the kind of macro backdrop that fuels exponential upside. We've already seen hints of it. Bitcoin's supply is tightening post-halving. Institutional demand through ETFs continues to climb. And with the Fed likely to turn on the liquidity taps again, risk assets could explode higher. Cathie's call isn't just about optimism. It's about understanding the timing of the cycle and positioning early. So, do you agree with Cathie's outlook? That the so-called rolling recession is giving way to a historic recovery? Or do you think the Fed will hold off longer and risk another market shock? Let me know what you think in the comments below. If you found this breakdown valuable, don't forget to like, subscribe, and turn on notifications so you don't miss our next deep dive into how top macro investors are preparing for the next leg of the bull market. Thanks for watching, and I'll see you in the next one.